Welcome to Module 3, where we're going to be talking about building a system. We need to do this to get away from what I see from nearly 100% of retail traders that I've met that exhibit this type of behavior. So they'll start out with a strategy, they'll learn about something, so they'll learn about some kind of technique of trading, or this could be a charting method, this could be a different type of trading strategy, different form of money management, it could be anything that catches their eye that somebody's talking about on the web. And so what they'll do is they'll invest some time, perhaps some money into that. They'll take a couple of trades, and ultimately these don't work out very well because they haven't done what we've talked about in the first two videos. They're trading right over the tops of the trees. They're afraid of losing money. They're trading not to lose instead of trading to win. For any number of reasons, these trades usually don't work. And then what they'll see is another magic penny over here on the internet. They'll see somebody talking about something else that looks really super simple and looks very successful. They will thunder over here like a herd and invest into this program, buy into this program, take the time, perhaps spend some money learning about something, take a few trades. Guess what? These don't work either. And then what they see is the next strategy over here. And so they go thundering over to here. And I just see this constant movement between different strategies where this is where we get into that notion of you become a jack of all trades and a master of none. And look, I understand, because you start losing a lot and all of a sudden you start really dropping in altitude in terms of your capital in your account. And so you feel that the best thing to do is to jump over here and look for this holy grail strategy or this one or this one. It doesn't matter, but I've seen this type of pattern nearly from everyone. Now, there's a big difference between doing this versus the speed dating that I talked about before. When you're doing the speed dating, when you're getting acquainted with different strategies or different assets, you're not risking a whole lot of money, if anything, doing that. You could certainly do this on paper trading. Learn to find your one trade without risking any capital in it. So now let me shift the discussion and talk about how professionals will set up a system. So what does a trading professional really do after all? Well, I would contend that it's just a transformation process where you take some inputs, you apply a process to them, and you get some output, which is hopefully profit. And this is why one of the best traders that I ever saw was actually a supply chain manager. He would start off with a certain amount of capital and would input that into his trading system and then would add a value-added process to that starting capital and end up with a profit from there, just like a supply chain that he ran. Now, here's the most important thing that he did was he added adjustments and feedback to the system. So those of you that are engineers will recognize that this is a closed-loop system where we bring feedback right back into the inputs again. And this is how every profitable business is run. Nobody just puts inputs into a profitable business and then expects that no adjustments have to be made going forward to continuously be profitable. And if you've ever seen any kind of Deming type of study or any kind of continuous process, then you've seen this type of graphic before. This is what I call the strategy development cycle, and we're going to make this specific to trading. So it's goals, rules, results, and corrections. We start off with our business plan, and we determine what our goals end up being. This is kind of the vision. This is the top-down approach that we're going to take for the business. We have to identify where it is that we're going before we can have any hope of getting there. And then if we're going to put risk capital into the market, we have got to have a set of rules, trading rules based on a strategy which has edge in the market that we're going to be trading in and hopefully has a positive profit factor. If it doesn't, then we have to make adjustments. And we won't know about those adjustments until we do get some results, which will tell us whether or not we're heading in the right direction or heading in the opposite direction. And here's the key for this, is that once we get the results, well, what a lot of people tend to do is if they don't get the results that they want, they sweep them under the rug. If they get good results, what they end up doing as far as a correction is they increase their position size, which is Usually not exactly the right thing to do, since many times they don't know why they got the good results to begin with. So this is the main key here, is that we have to get results and we have to identify root cause issues and then make corrections to that, so that perhaps we're going to go back to the beginning again and revisit whether our goals were accurate and attainable. And I put this graphic into the PDF, but this is something I want you to think about, is that we're not going to just do this once and then we're done. Unfortunately, we're going to, or fortunately, we're going to be doing this again and again and again. And the whole idea is that the quality of the system will increase the more that we run this. We don't want to be running this thing into the ground and getting it more negative the more that we run it. We want to be adding value every time that we go through this loop and finding something else out about this and getting just a little bit better. All we have to do is shoot for that 1% improvement every time that we go through the cycle. 1% improvement. This is really what we're shooting for, is that we'll end up kind of spiraling this whole process upward. To this end, we need a trading framework to turn this trading into a business and not just a hobby, or not just some kind of adrenaline-fueled venture that we're going to get into that feels fun. This is going to be something serious that we're going to apply purpose to. So to that end, we're going to build a framework. Now, this is just the minimum subset of what should be considered for a trading framework. First of all, we're going to start with a business plan specific to that strategy. This is going to be something that we are going to refer to on a regular basis, and not just write this up and then stick it up on the shelf, pat ourselves on the back and say, oh, check, I'm done with that. So business plan is intended to be a working document that you're always referring back to give you guidance in terms of what you're trying to do. Now, to that end, as far as putting this plan into a live trading market, this is where we need a trading plan and a strategy and instructions set for how we're going to apply risk capital into that market. Once we do get some results, we're going to journal those results, and this is where we need to do the analysis part of it. So we need to put this into some kind of form where we're going to get some answers from this data collection and not just create busy work for ourselves, which so many people don't like to do. From that point, we can actually do Pareto analysis. You've heard of the 80-20 rule? Well, chances are that 80% of your losses are going to come from 20% of the errors that are out there. Or you could flip that on its side, and 80% of your profits are going to come from 20% of your setups that you end up doing. So we need to identify these things through Pareto analysis. I'll show you that in just a minute. This is going to be something that perhaps at the very beginning you're going to struggle with, trying to identify root cause identification, and then based on that root cause, modifications. This is always something that takes experience for you to identify what the real problem is, and not just point your fingers at anything that's moving that appears to, like blaming something on whales or blaming something on market makers is not going to help, because there's nothing that you can do about that. You need to be able to identify root causes that you can have an impact on should you decide to change them. So that feedback loop has got to be incorporated into the next series of trades. So I don't care whether you do this once a day or once a week. It needs to be a regular process so that you can change things on the fly and see whether or not you're getting closer or further away from your goals. You've got to have this constant monitoring and evaluation. Otherwise, there's nothing that separates you from the average retail trader that is getting into markets just based on a gut feel or fear of missing out or any of the other numerous ways that we end up losing money. Here's a trader's business plan example. I'm not going to go through this thing point by point, but I'll just show you some of the elements that we have here. So first of all, a little executive summary never hurts, that this is what you're trying to do with this business. The trading plan will be built separately. Here's how I'm going to fund the business. And then in the text, what I do is I go over a staged type of trading. Remember, you should always consider yourself unworthy to trade live capital until you can prove it to yourself that you can do so. Earning the right to trade has a tremendous impact on your subconscious and your ability to handle risk in the market and not treat it like we always handle risk, which is a bad thing. Risk is a good thing if you treat it in the right manner. So we go through stage 1, stage 2, stage 3. Each of these is progressively takes on more risk and earns the right to trade a larger position. And then we talk about goals, cash withdrawals. So the whole purpose of trading is to make money from this and then a cash withdrawal to pay yourself with that. Intraday risk management. At what point are you going to fire yourself during the day? Some days you just don't have it. And it's better off than digging a hole is to stop digging once you're in a hole. And then plan maintenance. How often are you going to look at this plan and edit this plan? And then, of course, practice. Now, there's many, many other things that we can put into this business plan, such as like educational goals, or perhaps travel, or setting a budget for what you intend to spend on this business. There's many, many different avenues that I could have gone down from here, but this is just the basics of what a typical business plan will look like. Now let's cover the concept of a tracking tool. Now, there's a lot of different ways to do this, obviously. Let's talk about the purpose. First of all, a tracking tool of some type is necessary to help spot errors, root causes of loss, or any other of the innumerable types of data that we can get from our trading. This is a numerical form of journaling, but it also helps to have a literal form of journaling so you can see what you're thinking or feeling during a trade. Some people write this down as a diary. I tend to use something like Evernote to do a screenshot of the trade and then type in my thoughts during the trade. That's another method of doing this. But again, we're going to focus here on this tracking tool, and let's see how we might do something like that. Now, before I get into that, some of you are going to look at this and say, well, look, I don't get spreadsheets, or I don't have anything to do with them. I don't have any experience with Office or spreadsheets or Google Sheets or anything like that. So you can buy off-the-shelf products like perhaps one that I'm familiar with is Edgewonk, which is a piece of software. Again, these cost money to buy, whereas most of the spreadsheet tools, you can get a Google Docs account and use Google Sheets for free. So again, consider your budget behind your business and spend appropriately. All right, let's get into this tracking tool and show you how I build and use these things. Here's a spreadsheet that is going to be appended to this program. What I'll do is I'll kind of walk you through what I'm doing with this sheet. And then what I would encourage you to do is, instead of just downloading it and using it as is, I would encourage you to kind of use your own version of this, or definitely get in here and dig through it and make some changes. By doing so, you take ownership of this tool, and it's going to make a bigger impact on what you do. Okay, just a few things here. A lot of this is just data collection, like data in, data out, what the coin is, what the base currency is, things like this. And over here, I'm going to skip this portion for just a minute. Over here is more of the reporting results. So a lot of this is just collection data and then a calculation based on the result, the margin, things like that. So I'll walk through some of these numbers in a minute. So these are the results here. And what we have here in each of these columns is this represents a rule from our trading plan. So what we're trying to do in this case is we're setting up almost binary adherence to each of these rules per trade. So did you trade in the direction of the anchor chart swing? Yes or no? If it's no, what I want to do is I want to put a 1 in here, and I'm going to color that red because I want to call this out, kind of like what we have over here. So for each one of these, for every trade, I want to make sure that I can tick off and say, yes, I traded in the direction of the 5x RSI, 25x energy is greater than 40. Don't worry about what these mean yet because we haven't got to that point. But each one of these represents a rule, perhaps for trade entry, or in this case, like here, for an exit. Did you exit the trade correctly according to your plan? Did you size it correctly? Did you use rule number 2 of risk management to make sure that you're not risking more than 2% of your account on this particular trade? So again, don't get hung up on what each of these specific rules are. This is for you to place your trading rules into these columns, and then on a per trade basis, if you violate that rule, you got to mark a 1 in there. And the whole idea here is that you're going to summate you're going to sum up all of these columns here. And so what you'll find is that after a certain list of trades, perhaps you'll have maybe a 2 here, you'll have a 1, maybe a 3 or something like that. Maybe you get all the way down here and all of a sudden you show an 8 here. Uh-oh, there's a problem with that. And chances are you can probably correlate a very high number to perhaps even losses on the right-hand side. Now, what this feeds is the Pareto analysis. And what you can do with these is actually you can create a histogram for these occurrences. So you can sort these through histogram, and you can come up with like occurrences by trading rule, like this. And you're going to sort these things out. So maybe this is like correct exit execution, and maybe this histogram was confirmed 1x hook entry. And so this one was 8, and maybe this one is 6, and maybe this one is 4, and you get all the way down to maybe just one occurrence down here. Now, think about how we typically do things. This is the whole power of the Pareto analysis technique, is Pareto would say, well, look, what you want to focus on is find your number one offending error, and then work on this one first. Get rid of this one, because if you get rid of this one, you're going to get rid of half of the occurrences of potential execution error. What we tend to do is we tend to try to fix everything all at once, and it doesn't work out like that. Or we try to fix the things that really don't make much of an impact on our trading, which are the easy things to fix. It's kind of like you getting to the office first thing in the morning and you work on the easy stuff instead of the hard stuff. Well, this is what we're going to do with Pareto analysis. So once you tabulate all of the errors in these columns, and there will be errors because we're humans, you're going to add those up, and you're going to understand on a histogram basis what your errors are. And this is going to help you give structure to what you should be working on. So in this case, if my exit execution is all wrong and I keep making the same error, then why do I keep making the same error? Is there something more underlying that that's causing me to exit early or exit late, or just not even set an exit stop? Or what is it? What's the problem here? And this is where we need to dig into this one and fix this one first, and not try to fix everything all at once. Okay, let's move over to the right-hand side. I'm going to clear some of the graphics here. Let's talk about some of the right-hand side metrics that are out there. Again, just entry price, exit price. So from these, what we can determine is where'd you enter, where'd you exit, what kind of a result or return did you get, and then based on the margin, what kind of resulting percentage gain did you get based on the margin. Now, each of these is going to be different. These are going to be different metrics depending on what broker, because some brokers, you're not going to be looking at necessarily the margin, but you're going to be looking more at the actual risk of the trade. With a lot of the smaller synthetic futures brokers, you'll look at the margin and look at the return on that, and you'll see widely scattered returns from heavily positive ones to heavily negative ones, because again, that knife cuts both ways. So you'll have to fine tune this tool to determine what it is that you need based on what it is that you're trading. All right, here's one in particular I like, which is the MAE and MFE. You may not have heard of these terms before, but what I'm looking for is when I enter a position, how much heat did I take? Now, heat is represented by, after I enter the position, how many points did it go in the opposite direction? How many points did it go against me after I entered? Versus, what's the maximum favorable excursion? So we have the maximum adverse excursion, maximum favorable excursion here. So how far did it go in a positive direction for me? Now this is, if this is a short position, this is how far did it drop in the direction that I wanted it to. So this is a negative excursion. This is how much heat did I take and how much did it go in my direction for me. So ideally, what you want is you want this ratio to be, and the ratio is basically the MFE divided by MAE. And so you want this ratio as high as possible. The higher the ratio, the better your entries are getting to be. And then here up at the very top, we have, win percentage. That's easy to calculate. You can tabulate the gross wins. You can tabulate the gross losses. This is actually, there were no losses on these samples here. I just put a 1 in here, so I'm not dividing by 0, so I can come up with a profit factor. So profit factor of 46 is like impossible to maintain. You will have losses in there. And what you're trying to do, a profit factor is basically your gross winning profits divided by your gross losses. So you want that number as high as possible, but if you get this above 2 for any length of time, you're basically walking on water. So what I will shoot for is a profit factor of about 1.5. And if I can maintain that over time, I'm doing pretty well, and that'll be a profitable system. Now, the winning rate actually doesn't mean that much. And we can get into all kinds of debates about winning rates and expectancies and things like that. I want to keep things simple for you guys. A winning rate really doesn't matter. I can show you a profitable system, especially trend trading type of systems where you have a win rate of maybe 25 to 30% because you're taking lots of very small losses. But then once in a while, you just knock one out of the park and you have a huge win that pays for an enormous number of losses. And again, you can have a very positive profit factor for something like that, but you have to keep testing and testing and testing and trying to enter, keep getting kicked out. Now, most retail traders do not like strategies like that because they equate a winning percentage with self-confidence. And so a lot of retail traders like high winning rate percentages, right? So it depends on the type of strategy that you're going to trade. But I would say for more of the short-term trading strategies, we're not looking for the big trends. We're not looking for a big knock it out of the park. It's more of get in, get your fair share, and get out. So it's realistic to look for 60 to 70% from those as long as your losses aren't tremendously larger than your gains when you do lose and you do win. Okay. Enough on that. I also do have some trade school segments on using a spreadsheet like this, using a tracking sheet, how to interpret the data from there. So look for other resources from this above and beyond what we have in this module alone. Something I want to end this video with is I just want to make an impression upon you that you have to be your own performance coach. So unless you're lucky enough to have a committed trading partner, you will be responsible for self-governance in your own trading. And most of us have room to grow in that area, don't we, right? So how many times do we say, well, I'm going to try to get back onto a diet, or I'm going to quit this habit, or do this other thing? We tend not to have very good self-discipline over our own selves. And a lot of that is because we don't understand how to use the subconscious mind. This is why I suggest that if you want to pursue trading seriously, and this is just a matter of time, sooner or later, you're going to have to deal with your most formidable trading adversary, which is yourself. You're not really trading against the market. You are trading against yourself, and you'll eventually find that out. This one topic is the subject for entire courses that I have taught. So check with me for resources on self-coaching, and make sure that you start to tackle this topic, because sooner or later, you're going to have to deal with that. All right, let's wrap up this module about building a system. What do we need to do here? Number one, we need to create a business plan for your small account, a trader's business plan. We need to run this like a business and not like an expensive hobby. Number two, we need to take our one thing that we defined in the last module and create a trading plan based on that. So how do we create a trading plan that shows how we're going to enter, how we're going to manage a position, how we're going to exit, and then move forward around that trading plan using number three, which is the journaling tool, so that we can track and diagnose errors that we need to fix to increase our progress. And that's going to lead us to Module 4, where we're going to be talking about our mental edge as small account traders. See you there.